This one I want to talk about using an ancillary to get you out of maybe a profitable trade. In this example, short, let's say you're short from up here and you get the market to do what you thought it was going to do and it sells back off. What often happens, especially in volatile markets, is that if you get too greedy, it doesn't take much for a nice trade to turn into a scratch or even a loser. There's nothing worse than a nice winner turning into a nice loser, not just on your statement, but mentally. How do you avoid that? How do you minimize that? Take a look at this ancillary in the upper left hand corner. This is the VIXY. It's an ETF for the VIX. If it goes up, equities go down. If this goes down, the VIX, we go up, especially in volatile markets. So you see it come off, the ES come off. Now watch what happens to this bid offer. This is the bid, this is the offer, bid, offer, bid, offer, bid, offer. Watch what it does. If you see this get sold off, that's bullish for equities. So you see it go to 73, boom, 49. 73 bid, they dropped to 49. That helps you sooner rather than later predict that, watch the chart of the ES, do that and come all the way back to maybe where you got short in this great trade where you got 15 points into it. It's actually 20 points. It doesn't seem like much because all the volatility we've had. But from here, where my cursor is, there's a 20-point move, and it goes from a 20-point winner to a scratch and maybe a loser. Let's look at this again. Let me show you the drop that you had in the bid and obviously the offer, bid offer, not the last traded price. You want to watch the bid offer. You're going to see it move faster than just watching the last traded price. Watch this thing drop. The bid drops and obviously the offer drops. Bid offer, bid offer, bid offer. So play it, watch it. It's 66 bid, 80 offer, 82 bid, 73, 49. They drop it. They go from like, just let's watch the offer for a second. Just watch the offer for a second. Right before that moment, right in here. We're going to watch the offer 72 offer. So if you're in the pit, they're screaming, sell it at 72, 71, sell it at 70, 80 offer. They're yelling 80 offer, 80 offer, 80 offer, 88 offer, 69, 54. That's dropping. 41. They're dropping the offer. They're going to hit the bid. It's going to trend lower, trade lower, bullish for stocks. You're not going to catch the bottom, but it allows you to see into the future a little bit. And so a nice winner doesn't turn into a nice loser. This is just an example using ancillaries to help manage a trade. Everybody talks about, but where could I get out? Where should I get out? When can I get out? Ancillaries with a little leadership quality will help you that. Also, a rule of thumb is faster markets are moving around, the more likely you'll find an ancillary or correlated market that is providing leadership. There's a lead lag. There's no value unless there's a lead lag, at least something that's tight. It doesn't do us any good if the S&P rallies 10 points at the same time the VIX breaks a dollar, right? You need to have a little look into the future, even if it's a few seconds. And hey, listen, I know people like don't want to pay attention as much to some of these big moves. Well, then the faster the price moves, the faster you have to move, the faster you have to think. But you could slow things down by watching the right stuff. And most people aren't watching the right stuff in slow markets. They're going to get killed if they're not watching the right stuff in fast markets.